Dear students, let's come back to financial management, capital budgeting chapter. Last session we had dealt with the payback bailout and the payback reciprocal. Now I am continuing with the discounting techniques used for capital budgeting. We had already gone through discounted payback method. Today's session I will be dealing with net present value method. See, the main difference between these two is that is discounted payback and net present value method is that in net present value the entire cash inflow of the plant of its life will be taken. That is the entire series of cash inflow till the lifespan of the project will be taken into, till the lifespan of the project or plant will be taken into consideration. That is in case of discounted payback method, the year will be around 5 years or 6 years estimated they will be given, but net present value the entire series of cash flow will be given. Now what is net present value? It is actually similar to discounted payback method. From the name itself it is clear, it is defined like this. Net present value is the difference between present value of benefits and the present value of cost. What is this present value of benefits? Present value of benefit is actually CFAT, cash flow after tax. Why it is called as present value? Present value of benefits means the estimated cash flow at the present value of money. So again it is time value is taken into consideration. That is why it is called as discounting technique. Time value is taken into consideration. So present value of cash inflow is compared with present value of investment or cost. If NPV is positive, the project proposal will be accepted, and if it is negative, it will be rejected. As I told, it takes into consideration all cash inflow occurring over the entire life of the project. That is the fundamental difference between NPV and discounted payback method. Discounted payback method does not take into consideration the entire series of cash flow. It will specify 5 or 6 like that, or 4 years in 4 years cash flow only will be given in the discounted payback method. But here it will be clearly mentioned that the entire cash flow, entire life span of the project is taken into consideration under the NPV. So let us directly get into the acceptance rule. Acceptance rule is that NPV is greater than 0, it is positive NPV. NPV is less than 0, it is negative NPV. If it is negative, we have to reject, and if it is positive, we have to accept. If the NPV is equal to 0, the firm will be indifferent. What do you mean by indifferent? Its acceptance will be in rare case, as it indicates that only original investment will be recovered. Why? Because if 10,000 we are investing, okay, and we are getting the return according to the present value of money 10,000 only, then we are not getting any profit from the project. So that is why it is mentioned in rare case only if it will be accepted. But if we are investing 10,000 in the first case, positive, we are investing 10,000 and getting the return, okay, we're getting the return 15,000 according to the present value of money. After taking time value of money, the return now we are anticipating 15,000. Then what is it? This is positive NPV. Okay, and if we are investing 10,000, we are getting the return according to the present value of money 9,000 only. 9,000 only, it is less than the investment, so it is negative NPV. So in this case, if it is positive, we have to accept the project. Negative, we have to reject the project. And here the firm will be indifferent, in the sense they may or may not accept according to situation, because there is neither profit nor loss. But in majority cases, here also sometimes they may reject because there is no profit. Let us get into the problem. There are two types of problems for NPV: irregular cash inflow and or different cash inflow, and with regular cash inflow. The two I will lead into two problems. First I will deal in this video clip irregular cash inflow, and the second video incoming I will be dealing with regular cash inflow. So here also one important point is that inside the question, before getting into the question, inside the question they will give just like the discount. You could see the earlier scanned paper which I had given to you, which I had sent to you early. Discounted payback method, existing investment of the company. We had already dealt with this problem. Geon Mobiles, okay, like existing capital investment of the company and the cash inflow. They will be giving one more information. What was it? Expected rate of return, 12%. That is the discount rate. Okay, so that discount rate will be given in this method also, net present value. Discounted rate, here it will be mentioned in different ways. Sometimes they will mention that discount rate is in the form of KO. What is KO? KO is overall cost of capital. KO or K, they will sometimes give us K, cost of capital of the company. What is cost of capital? It's a minimum rate of return a firm must earn on its investment. Minimum rate of return a firm must earn on its investment where the market value remain unchanged. This technical jargon you don't want to deal now, because there is already a chapter, cost of capital, which comes in the third module. Now you just understand that it is the rate of return the company have to get from its investment. So if we take the problem, okay, what are the informations given? Let us go through this problem. Okay, initial investment is 56,125 for a company in a project, and they are getting the return, cash inflow after tax for the 5 years. It is mentioned in the question, lifetime. So the anticipated lifetime of the project or machinery is 5 years, and the return is given 14,000. First year, second year 16, third year 18, fourth year 20, and fifth year 25,000. Find out the project feasibility under NPV and comment. That is the question. This problem in a different different method of capital budgeting I had already gone through. Do you remember? If you take the second second page scanned page, okay, you could see that we had already dealt with this problem under the payback method. So the same problem I am taking here in order to compare with the payback method and this under payback method under the non-discounting technique and NPV under discounting technique. So the problem is same. Firm investing 56,125 and the returns for the 5 years. The same problem I am taking here. For your reference, I had shown that paper. Now let us see how we will do this problem. So the informations available are the initial investment made by the company is how much? Initial investment is equal to 56,125 rupees. Okay. And the return given in the question is 14, 16, 18, 20, 25,000. Okay, in rupees. These two things are first two columns. If you look into the columnar tabulation, the first two column informations are given in the question. 56,125 is initial investment, and the return for the next 5 years is given. And the next 5 years, it is mentioned clearly in the question that it is the lifespan of the project. It indicates clearly that it is an NPV question. Or else they will mention in the question itself, find out the NPV. Then also you have to understand that the lifespan of the machine will be maximum 5 years. Now what we are doing, the name itself, it is clear, net present value. So this return, every year return, we have to convert it in under the net present value by taking into consideration the time value of money. So like discounted payback method, I am using I.M. Pandey textbook and taking the table. Which table we will use? You could look into this. We will not use compound value table. Table A and table B, two tables are there, compound value. It is not which we use. Here we are using discounting tables. Okay. and you look into the difference between the table compound value and present value. Present value tables are discounting tables, and compound value tables are for finding out the future value. Now present value, we will use 1 rupee table. Okay, present value 1 rupee table. How we will take the interest rate? In the question it is mentioned, okay, in the question it is mentioned that interest rate or KO of the project is 10%. KO of the project is 10%. No, so what is KO? KO is the ARR or IRR or the expected rate of return or cost of capital itself. Technically it is cost of capital. So with that information we could take the discounting factor, that is 10%. So look into the table clearly. 10% we will find out from the table C, present value rupee 1. Why we are using present value rupee 1 table? Because we are having irregular cash inflows. That is, the cash inflows are not regular. Regular means what? Every year we should get 14,000 or the same amount. Here it is irregular. That is why we are using present value rupee 1 table. If the cash inflows are irregular, we have to use rupee 1 table, present value rupee 1 table. So 10% we are taking, and first year, what is it? First year the value is, the earlier problem we had used 12%. First year the value is 0.9009 at 10%. So we are putting that thing like that. For the next 4 years we are taking 10 at 10%. Second year it is 0.826. Third year it is 0.751. Fourth year it is 0.683. Fifth year it is 0.621. What all these values indicates? It indicates that rupee 1 invested in the first year January will be having the value of 0.909 paise at the end of the year. Rupee 1 invested at the year 1 will have the value of 0.826 in the second year end. Like that, rupee value will get deteriorated every year. That is the concept of time value. This I had taken in the discounted payback method too. Same concept we are applying here. So with the rupee 1 value or the present value factor at 10%, we will find out the existing net present value. So this column 4 is what? Column 2 into column 3. 14,000 into the present value factor, we will get the present value or net present value of 14,000. Means what? Year 1, we are getting the return 14,000 is having only the present value of 12,726. Like that we calculate for all 5 years of the entire lifespan of the project. 16,000 into NPV factor, we will get 13,216. 18,000 into 0.751, we will get 13,518. 20,000 into 0.683, we will get 13,660, and 25,000 into 0.621, we will get 15,525. So the total, what is the return? 68,645 is the return which we are getting from the project. So 56,000 we had, 56,000 is the initial investment which we had made into the company. And we are getting the return how much? 68,645 rupees after taking into consideration the time value of money. So what it indicates? It indicates that net present value is higher than the present value of cash outflow. Net present value of cash inflow, I will describe it once more. Net present value of cash inflow or CFAT, which is 68,645, is greater than what? The initial investment of 56,125. That is 56,125 is the initial investment which we had made, which is greater than initial for 68,645, the return which we had got is greater than the present value of cash outflow 56,125. So it is positive. So that is the acceptance rule. We could accept the project because The net present value of cash inflow 68,645 is greater than the initial investment 56,125. So this is all about irregular cash inflow problem under the net present value method. Thank you.